Hi everybody, imagine if you could predict exactly when your money would double or triple or even grow into millions, all with a few simple calculations. Today, I will be sharing 10 game-changing thumb rules that will help you build wealth faster and smarter. Also, these rules will guide you to take smart investing decisions. Well, let me first explain what thumb rules mean. Thumb rules are nothing but certain guiding principles which may not be 100% accurate but are sufficiently error-free, and more importantly, they are based on real life situations rather than theory. Now let's jump into these golden thumb rules for saving and investing. First up is Rule of 72, one of the simplest and most effective way to estimate when your investment will double. It says, take the number 72 and divide it by annual rate of return. The result that you will get is the number of years it will take for your money to double. For example, if you invest in a fixed deposit offering 6% annual interest, divide 72 by 6, which gives you 12. So your money will double in 12 years. If the return is 8%, it doubles in 9 years. It's a handy tool for making quick decisions and planning long-term investments. Next we have the rule of 114, which helps you figure out how long it will take for your money to triple. Just like with the rule of 72, you divide 114 by the annual interest rate, growth potential of your investments over time. Now let's talk about inflation. The rule of 70 is designed to show how inflation erodes the value of your money. Simply divide 70 by the inflation rate to see how long it will take for money's value to cut into half. Let's say inflation is 5%. 70 divided by 5 gives you 14 years. So in 14 years, the money you have now could lose half of its purchasing power if you just let it sit without investing. This rule emphasizes why it's so important to make your money work for you. Now let's talk about the rule 1263. It's about expected returns from three essential asset classes: equities, debt, and savings. Basically, it says while making a decision, assume you will get 12% from stocks, 6% from bonds, and 3% from a regular savings account. While these numbers aren't set in stone, they give you a rough idea of what to expect. It's a quick and easy way to prioritize your investments based on your risk tolerance and financial goals. Next is the 15-15-15 rule. It's quite popular for creating wealth. If you invest 15,000 per month for 15 years in a mutual fund that earns 15% annually, you will accumulate over 1 crore by the end of the 15-year period. Now 15% returns might sound you ambitious, but the rule demonstrates the power of long-term investing and the impact of compounding. You can adjust this rule to fit your budget, like you can try out 20-12-15 formula, where you invest rupees 20,000 at 12% for 15 years to achieve a similar goal. Next is the 12.2% rule. Well, it's simple. If you invest at 12.2% annually, your money will grow 10 times in 20 years. This has been a key driver in many long-term financial plans. It's based on the assumption that equities on an average can deliver about 12.2% return per annum over the long-term period. This rule can really help you visualize your financial future, especially for retirement planning and even funding your children's education. Next, this rule is very commonly used by the investment advisors, the 100 minus age rule. This rule helps with asset allocation. It simply says subtract your age from 100, and the balance that you get is the percentage of your portfolio investments that should be in stocks. For example, if you are 30 years old, then 70% of your portfolio should be in equities and 30% in safer assets like FD, bond, or debt mutual fund. This rule is a good starting point, but remember that your goals, risk tolerance, and financial situation should also factor into your asset allocation. Next rule is the 30% stop loss rule. Investing in stocks are very risky, and the 30% stop loss rule is one that can save you from losing money in the event if your stock doesn't move as per your expectations. If any stock in your portfolio drops by 30%, simply sell it off. It's a way to limit your losses and avoid getting too emotionally attached to an underperforming investment. This rule keeps you grounded and prevents significant losses from piling up. Now let's switch gears to spending. The 1 week spending rule helps you control impulsive purchases. When something shiny catches your eyes, wait a week before buying it. Ask yourself, is this purchase necessary? How was I managing without it? And could this money be used for something more important? If after a week you still want it, then go ahead, purchase it. But more often than not, you will find that your initial desire fades away within this 1 week time frame. Finally, let's talk about insurance. The 20x life insurance rule. This rule suggests that your life cover should be at least 20 times your annual income. This ensures your family is financially protected in the event of your untimely demise. It's important to secure this early as premiums are cheap when you are younger. Here are the 10 simple powerful rules to follow for saving and investing. These thumb rules can be incredibly helpful for making quick financial decisions, but always remember to adopt them to your unique situation. If you found these rules useful, hit that like button and share this video with someone who might benefit from these rules. Don't forget to subscribe to my channel for more videos like this. I will see you in the next video. Signing off, Samesh Rajpal.